Hey, good evening, guys. Ken at Tortoise Capital. It is the nightly strategy podcast for September 18th, 2020. Thank you for your patience. Let me start off with just a note that tomorrow morning's Q&A podcast, the topic on that one is going to be as much of the 37 strategies document as I can get through. That's going to start at 2 p.m. Central instead of the normal 10 o'clock Central time. We have a soccer match in the morning, and I need to push that to 2 p.m. And again, that'll be on the 37 strategies document and continuing that lesson. If I can, I will try to get that completed tomorrow and put that thing to bed. All right. The weekend report is posted to Patreon and is available there also in the handouts section. So let's just start with a recap of what happened today. All right. So yesterday we started off with this market that had come back down and tested Z1. And we were justifiably concerned about that retesting the belly of the RL10. And we said if that happened, that we could get a short position, and that our next target would be down here at the Z2, and then you could see possibly Z3. And what happened was that we got a fractional gap down. It broke down through the low of the day. Of yesterday, it broke down through the belly of the RL10, and we got the move all the way down to Z2, followed by a slight rebound at the close, but essentially made a whole series of new lows. So the move from 332 went all the way down to 328. So that was like a minus 1.4% on the initial burst down. So that was set up for it set up a new 10-day low, a new 30-day low, all of which held support finally at the Z2 at 328, call it 328. So we've got two new working lows to contend with. So that was a pretty directional move for the end of the week, going into the weekend for it to move down that sharply. Monday, if this fails again, then if it breaks down below that working 10-day and 30-day low in Z2, then it's within spitting distance of the Z3, which will be which also puts the 10% sell-off in the beginning of a really big downward move in play. So this is not promising at all. The case to the upside has to get through the high of the day, which would be at Z1, and is co-located with the baby dragon, the RL10 price, the lower skin of the dragon. There's the spine of the dragon. There's the upper skin of the dragon and the Bollinger Band mean. And this is also where that RL30 extension. You can see that the black line, which is the health of the trend, getting noticeably steeper down. On Monday, the PSAR excursion will be down here at PSAR +1, which is it's going to be at about call it 344.5. So it still has to get through that PSAR for for this to be anything but uh, a downward move. We'll notice that the first leg down sell-off held support, rebounded 3.5% to the skin of the dragon, hit the wall, and has now retraced another 4% on the way down. So we're having this big strong bull, first wave sell-off, a halfway up the stack rebound, and now looking like this. So we now have even clearer indication of that downward trend, as we have two lower lows, and we have a lower high and a lower low. So if we looked at this as a 1, 2, 3, 4, that made today a collapsing dragon move. And so that set up a really nice intraday short. So the bias is definitely to the downside right now. We'll notice that the 30-day range from the high to the low, 30-day high was made here now 12 days ago, and it's a 8.7% move from the high to the low. The 10-day range, that 10-day high was made 10 days ago. Come on. The 10-day high was made really 10 days ago. The new 10-day high is going to be here. Come on. Starting Monday, that new 10-day high moves from here all the way down to here, as that new 10-day range is going to look like this. So it really has left that excess gain behind. And there's leg 1 down, leg 2 down. This is starting leg 3 down. So this is just cascading weakness altogether. Not good. Let's take a look at the sectors and the targets and see what happened today. All right, so our S&P was down 1.5% today. Diamonds were down 1.1%. The Russell was down only 0.26%, and Treasuries also were down minus 0.3. That's the one that I'm still having trouble getting my head wrapped around. It still seems like that should be doing better as in this market that's selling off. Just not sure I get that. All right, let's see what did better in terms of the sectors than the S&P. So we had consumer discretionary was slightly better at only minus 1.35, silver minus 1.2, energy minus 1.1, emerging markets minus 0.8, Bill Ackman's hedge fund at minus 0.7, Japan minus 0.4. Now doing better than even the small caps was finance minus 0.2, with the FANGs minus 0.18, and healthcare at minus 1.5. Surprisingly, the VIX was down minus 0.12. That had a much better move intraday, and then I think that was a case of guys taking their tactical gains intraday and not carrying that position over the weekend in these politically trying times. XOP oil exploration was basically flat. Clean energy positive 1.47. And now we can look at some of the companies that did well. Cisco marginally better at minus 1.34. There's Walmart, Alcoa, Cat, Facebook, and Intel all around the minus 0.9 area. Salesforce minus 0.7. And then in the green today, the proud. Goldman Sachs was flat. Virgin Galactic 0.17. Then the material sector was one of the lone bright spots. Here's Nucor Steel at 0.43. Nikola at 1%. Twitter 2%. Cliff 4%. Tesla 4.4. And then another big day in U.S. Steel at plus 4.88. That was a trade I cashed some profits and did not carry that over the weekend. Just much too vulnerable to the downside. Let's come back, take a look at the S&P. The things that were worse than the S&P today. Let's look at the sectors first. This is how we build our logic chain going into Monday. So we had this little triumvirate here of Mexico, materials, and tech at around minus 1.7. That is what makes the Nucor Steel and U.S. Steel, performances today, kind of special that they were able to do that even while their broad sector was down. So U.S. Steel and Cliff better than 4 and 5%, while their sector was down minus 1.7. There's wheat and precious metals at minus 2.5. That's another surprising one to me. Commercial real estate represented by Simon Property Group 2.8. And then Brazil minus 4.5. And then in the battle of the triple techs, the triple Qs were down 3.8, and the broad tech sector itself minus 5.1. So those are significantly higher than their intraday lows. So some of the companies that underperformed, there's Home Depot minus 1.7, Devon Energy minus 1.71, Amazon, Win, Nvidia, and Google. So some key tech leaders were suffering. Apple minus 3%, and Boeing minus 3.8. So much broader weakness than there was the few momentary areas of improvement. So this was a pretty disappointing day and a pretty disappointing week. Okay. So I want to get into the weekend report next. And what we'll do is, in the usual way, tomorrow at 2, I'll be covering the Q&A for the hybrid workshop. I may be able to get some trade frames discussed at that point. But the review of your trade frames that you want me to study are we'll do that in the Sunday evening podcast, okay, at 8 o'clock on Sunday evening. So if you want to hear commentary on that, again, let's get that posted in the chat room, and then we'll cover that on Sunday night. Okay, so here we are on a review of the weekend report for tomorrow, September 19th. We remain in bullish normal conditions, but you can now see we've come out of the overbought on the annual basis. We're now down at the high end of average at 80, and the 90-day is at 67. So still above average, but we've come out of the overbought conditions. And then today we made new breakdown lows in the 30-day, 10-day, and the 3-day lookbacks. This is a bit different than we were just 10 days ago when everything was overbought and the market could do no wrong and the sky was the limit. Well, it turns out the sky was, maybe it was the limit after all. The 200-day moving average is now only 6.67% above the 200. So we're still bullish, but it's quite a bit different than the 14% that we saw 10 days ago. The ADX has come back into normal bounds here. It's just a strong bull now at 27, but a lot of that trending strength has dissipated. One of the downsides of ADX as a measure of current strength is that we're seeing an accelerating downward move, but the ADX lags so much that it's down from 44 to 27. And so just a reading of 27 taken by itself would say, oh, well, we have a strong bull. And it masks the pain and suffering that comes from that recent sell-off. So it's more of a, in my view, a useful indicator on the way up to tell you when you are really in nosebleed territory, and not something that I take without that context. So I'm interested in the direction of change on the ADX, as well as the extreme conditions that it gets into. So when it gets to an abnormally strong or an abnormally weak setting, then I am more interested in its readings. ATR percentage is now at 2.2%. So that's up from where it was at 0.8%. So almost 3 times as volatile today than it was even as little as 10 days ago. So it's gone from a 0.8% daily ATR to 2.2. The risk Z just has been giving us that reliable alerts about A, we're extended, and B, advised. It gave us that alert, almost 15 days ago that things had, that upward move was getting weaker and that the potential of a downside was there. And in fact, we got that move. And even though it's rising, it's still where it is at below zero is still a cautionary tale. But to be honest, the near 10% sell-off that we have now actually makes the case for bullish swings a little bit better if you're to look at the indicator. Now, there's other reasons, like only being 45 days away from a contentious election with lots more shenanigans to come, makes this still problematic. It makes me glad that we had gone through the analysis of longer-term market considerations back in July when I took the core positions off the table through the election period. I sort of wish that treasuries were doing better, but still, it's a more comfortable place to be in. Our holdings for blended month rebalancing are not due to be redone until October. These are the holdings in the various model portfolios, and then these are the holdings as of today's closing prices. So still the consumer discretionary and techs, wheat and precious and clean energy and basic materials, now moving to the fore. You can see that strength in clean energy here, metals and mining, Apple and Caterpillar here. The ETF2 theoretical exposure, that should read 90%. I forgot to edit that part. So there was one of the indexes that was under its 4-month moving average. So that should actually read 90%. You heard it here first. This is the weekly. Oh, the monthly market health check. Got a little ahead of myself. So we talked last, actually a couple weeks ago, we talked about the remarkable move up here to the Z3, and it actually went higher and pushed beyond Z3, right up. I mean, the previous Z3 pushed all the way up to Z3, and then it's been nothing but given back the entire gains of August with the September sell-off, which brings it back to, the edge of the dragon. I would treat the dragon as the real noise buffer and boundary, which on a monthly basis is protecting 300. And I talked last week that 340 was significant to me, and 330 was a key price level, and now we're staring 320 in the face, and I can't see you letting it get past 310. It seems to me that we've had opportunities this week to cash those excess gains, and so anytime you see that price pushing up to Z3 on the monthly, and then it's starting to roll over, that has been an important warning sign. So the monthly guys aren't worried at all until it breaks through the Bollinger Band mean down here around 290. But I feel like this was the blow off of the excess gains. Then this is the nervous gains that people want to hold on to. So I can foresee selling in that direction. Long-term fair value still way down here. Can't read that. It's at 250. So the monthly is clearly flashing some warning signs. The weekly, it pushed as high as the Z2. And now we've had 3 lower closes in a row and closed poorly. And it's right at the edge of that weekly dragon at 330-ish. And I just think the, being flat there would make you pretty happy. Because if you're flat now, you have locked in, all the gains from that potential area. The next support levels are right here at long-term fair value and the RL90 and the PSAR. That's pretty key, and that will get you, 320 is the line in the sand there. The next price level down, just looking at the Z-score ladder, Bollinger Band mean at about, call 304, Z1, Z2, God forbid Z3. So this actually, in my view, is a legitimate time to start thinking about, tactical opportunities to the upside, because you had this tremendous move up. Awesome. You've now had a measured move down to the bottom of the dragon in the PSAR. If it holds anywhere in here. And now this is, we would think of this as a critical state and a move to the critical state. And there's an equal likelihood, in my view, of the next week to 10 days of going in either one of those directions. And a retest up here to 330 is certainly in order. And so that gives you a nice target to the upside of about 3.5%, I would say. let's see, because that's 20 bucks. So that would be about 7% rebound to the upside. Another 7% sell off takes you down to the Bollinger Band mean. So that's a nice critical state to be in for the move starting off next week. We've seen the daily already. We'll look now through the BMR portfolios. Japan was a store of value, and I was surprised to see that the Russell held off better than the Qs, and it did better than the S&P. So the more tactical folks are locking in their gains and are not as maybe not as concerned because they can turn on a dime. Latin America and real estate just as bad as they can be. ETF 22. Again, we had energy had a pretty good week. Is that a tactical bounce on something that's wickedly oversold until further notice? Yeah, but that is one of the few bright spots out there. ETF 32, clean energy. I've been beating the drum on that one, and that's one of the core portfolio holdings in BMR. That's offset by I find it a little harder to believe in, why Wheaton is not doing better. So that's going to be a tactical play to keep my eye on there. Technology, big weakness, whether it's the sector or the Qs, either one was troublesome. But they've both been above average performers. So if there's anything that's going to lead us up next week, I would start thinking about tech. Commodities, DBC, the blended commodity, up 4%. Food up 1.8 for the week, 4% for the month, and maybe there's some more there worth stalking. Energy and oil exploration, which had been horrible, had their day in the sun this week with some rebounds. So those are three ideas that I think are legit for next week. Is the question, will energy continue its little tactical rebound? Will the commodities maintain their momentum? Will tech lead us up? And then the long-term quiet positioning into clean energy, again, looks like a reasonable position to me. At some point, a doubling in the last 6 months is a cause for some concern, but it's hard to argue with the recent results, and it's a very liquid ETF. So that's a longer-term macroeconomic play that may have some more use. Maybe it can carry more water. Okay, so in the Dow 30, we're looking at Merck had some gains, and then Walgreens finally started turning the corner, and that just looks like quality company on sale, and might as well buy it at a cheap price. It's good business, but that had a rebound. But the things that suffered, Apple was a big disappointment, giving back 7% this week, and that just makes it more attractive in my view. Nike down 3%. American Express down 3.5%, JP Morgan down 4% as part of that weakness in finance. And Goldman Sachs had been the best performer in the finance sector, but it just feels like that's getting assassinated along with the rest of the entire sector. Sector spiders, there's metals and mining. Not too shabby. So the world of things is actually doing better. We had food, commodities, and there's metals and mining. Biotech on hopes for antivirus. Oil and gas equipment, exploration in the broad energy sector. These just look like tactical plays based on buying quality assets on sale. So again, that's one of the big questions next week. Does that maintain its short-term outperformance? In the large sector analysis here, looking at ETF Max. Again, these are the top performers. Had a few standouts: metals and mining, and China materials, China consumer, clean energy. But again, from the extreme conditions, you also you can get some extreme negative results here, like the gold miners were a disappointment. Market health check in the regional report here. Latin America is the first of the big indices to crack below its 4-month moving average. So because that's weak, we are at 90%. That's that earlier area I needed you to make a pen and ink correction on. So we're at 90 and 10 in the theoretical model, because one of the 10 symbols is on a cash position. Still bullish normal. The S&P is better than the globals, but barely. That's 30 compared to EFA at 28. Energy has been the beaten down sector. Consumer discretionary and tech have been the better positioned, along with materials. And still the equities have been better than the other the broad asset classes. Although this may have been the beginning of a recovery in commodities that we saw. Hasn't translated yet into ETF2 strength, but that's an area that could get better. The U.S. was generally above average, except for the mid-cap values. And then materials and consumer discretionary with some strength. Materials, South Korea, Germany, and India are the new strength. Silver and gold remain strong at the top. And then there's some growing weakness here, the white and green. And the white and green, these are all ones that are a cautionary tale. Now white, used to be green, was great, now just good. You want to make sure that you're preserving profits. Maybe there's a chance for them to rebound and resume, but this is one that you want to make sure that you preserve your profits first. Shifting to the daily, the S&P on a channeling signal, and then the 10-day min pains. These are the non-tech guys, with the exception of Honeywell. So Honeywell is an interesting one to me. Great company, just added to the Dow, has sold off less than its counterparts in the techs. So that's one to put. That's one certainly to put on our short list. The 10-day max pains dominated by tech and finance. And again, you're seeing Apple, Facebook, Amazon, Halliburton in that stack, and the Qs. The former leaders have been taken to the woodshed and beaten. Just a few dojis here in the Dow. A number of good channeling signals. So like Walmart is of great interest now. It was a doji. It's a channeling signal. It's a triple screen. It's a max pain candidate and offers 2.6 to 1 on the auto framer. So Walmart is certainly a high priority to frame. By the same token, I think Apple, it's 2.6 to 1. It is suffering now on these pullbacks all the way back to a monthly pullback. So I think you do have a chance to think about buying Apple on sale. So it's channeling and 2.6 to 1 on the auto framer. Goldman Sachs, I think you have to respect the opportunity of getting a 3.8 percent. A 3.8 reward to risk. And there's a 5DD in American Express and a 5DD in Nike. And otherwise, Nike has been pretty good, except for the one-day performance. Among the ETFs, again, a handful of dojis, plenty of channeling signals to look at. Nothing tests out better than 2 to 1 on the auto framer. That's because of the width of the range today. Made it hard to find 2 to 1s. There's a triple screen in finance. And significantly a breakdown in Brazil. In a more important warning sign on the breakdown in the 10-day and 1-month NDX in the S&P, and also in consumer staples. So those feel important to me right there as signs of weakness. Auto framer has plenty to choose from that are better than 2 to 1. There's Goldman Sachs, Morgan Stanley, JP Morgan, Apple, Walmart, Chevron, and Disney. There's our old buddy Microsoft right on the 2.2 to 1 boundary. Some daily squeezes ready for the pop. There's silver, gold miners, Oracle, treasuries. In that stack, Walmart's very near the 2.0 cutoff. So again, a few symbols that are still ready to pop. The MACD Four Seasons being dominated by the winter, both on the ETFs and for the Dow 30. And if it's not in the winter, it's basically in the fall and falling. And only 3M in the summer, and Japan in the summer. So hard to see Japan leading us on to victory, but certainly it's an equity index that's been a little more stable than the other broad indexes in the world. It's holding off the weakness better, so it has that going for it. Multi-time frame NDX summary. Again, breakdowns in Apple, very discouraging today. Brazil, the S&P, and consumer staples, big breakdown on the 3-day NDX. Many others join it. Metals and mining, one of the few bright spots today. And Walgreens, again, that's sort of the anomaly in there. That may be worth looking at as to see if that's actually evidence of a turnaround, or whether that was just kind of knee-jerk buying the worst performer in the Dow on sale. Again, because you notice on a 270-day period, that's the only NDX that's in the red at 10. So maybe this is just Walgreens. The deep discounted value buyers have hit their threshold to start buying, Dow companies when they're so dramatically oversold. After a very strong bull, this thing is still in the bottom 10% of its annual performance level. So maybe that's something to look at. Oops. Weakness here in the 30-day regression line slope. The slope itself is flat, and the parabolic or the polynomial has rolled over underneath it. So that's a sign of weakness. It actually crossed below the average of the last 180 days, going below that dotted red line and tipped slightly negative. And you can put that into context. The last time it broke below that dotted line was back here, and that's what happened next. The last time it was near that, but it didn't cross, it actually held up, and it got, there was a mini bull happening in here. But now that's all been given back, and it's right on the boundary of crashing. And now here, in terms of the percent stretch, it's still marginally safe, but that's really the support level right there. Volatility of ATR percentage has gone from extremely quiet to the boundary of noisy. The southern skin of the river did not hold, and it just started that breakdown today. This last time it held, and when it held, it gave us this. But here it is beginning to not hold. That's the last time that it didn't hold. And we got that. Not saying that's going to happen. You never step in the same river twice, but this is one that does not feel good. Okay. And that's everything that I want to cover for the weekend report and the daily for Monday. And tomorrow, again, starting at 2, we'll take a look at the 37 strategies for Q&A, plus anything that's been posted since then. That's going to start at 2. And then Sunday night, we'll do the standard trade framing as usual. Okay? So thank you very much, guys, for hanging in there. Been a challenging week. There have been some opportunities. I will tell you, the intraday trading this week and the charts posted in the chat room and on Patreon, those case studies have been very, very instructive about how to trade during turning points in the swing market. And they are very much worth your time and attention. Okay? And I feel like our indicators have been very good guides, disciplined, adaptive, mathematical guides to the changing market conditions. And the signs are there for us to read. We just got to be clear in our eyesight and in our judgment. So hang in there, maintain your courage, and we will see you on this weekend. Be safe, and we'll get back to work on Monday.